Hi there, Steve Rubis, the Fix It IR guy. Today we want to talk about growth expectations. Growth rates and secular growth drivers are going to dictate whether investors view your stock as a growth stock or not. If you are a growth stock, what are investors' growth expectations? Well, it's important to remember that growth expectations are relative. They're relative to your industry, relative to your competitors, and relative to the secular growth drivers you benefit from. So if growth rates are relative, then how do you determine an optimal growth target for your company? Well, what we're going to do is walk through 6 questions that you should consider when trying to determine optimal growth rate targets. First, is your industry growing or contracting? Ideally, you're a company that's a share gainer in a growing market. The worst position to be is a share donor in a contracting market. And essentially where you fall within a spectrum of about 6 different types of companies will determine on whether you need to have a premium in your growth rate and whether it's going to be harder work for the IR team to get people interested in the stock. Secondly, how to determine if the industry is growing or not. Well, a place to start is to look at third-party research. If you're in technology, you can look at Gartner or Forrester. If you're in shipping, you can look at Clarkson's and several other types of data sets. Next, you move to the sell-side research and kind of get a sense of what are different companies growing at, what are analyst estimates. And then if you really want to do a deep dive, what the IR team should do is get their proxy filing, look up the proxy comps that are used to determine compensation for your executives, and then go to the sell side and figure out what are the street comps for your company. And what you're going to do is you're going to set up a football field here. You're going to look at the aggregate growth rate, the median growth rate, and the mean growth rate to triangulate what that optimal growth target might be for your company. The third question is, does your company benefit from secular growth drivers? If it does, it's going to be easier to set a higher growth target and it's going to be more believable. If you don't have secular growth drivers, you're not going to need as large a growth rate to attract investors. Which leads to question 4, what is the total addressable market or TAM? It's important to be able to provide a thoughtful and thorough understanding of the TAM for investors. By giving the data points of what the size and what the company is playing for is what provides the believability to your message in investors' eyes. The 5th question is, how complex is your story? The more complexity, the more work it's going to take from IR to get people engaged, and you're going to have to come up with a higher growth rate because there's just going to be a discount here because investors don't want to engage with complexity. The last question is, what is your valuation? If you know your primary valuation drivers, that's going to help you own in on what are the key growth metrics I need to look at. And beyond that, they're going to help you figure out what are optimal growth rates on those key metrics. So now that we've gone through the 6 questions, you have to think about messaging this topic. Well, the best way to start is with an Analyst Day. An Analyst Day allows you to anchor investor expectations to key data sets that you establish in your investor presentation. You then work that information into your quarterly earnings and act accordingly, whether you give quarterly guidance or annual guidance. And then ultimately, to give you a practical example of industries or companies that have an ideal growth rate, is the SaaS rule of 40. The idea that you want a company that can generate 20% plus growth, 20% plus profit margins, the sum of the two combining to the number of 40. Now, if you're a different industry, I think this exercise is very valuable. What you'll want to note is that number 40 could be lower than 40 because you may be a slower growing industry or you may suffer from lower margins. But the goal here is, if you apply this analysis to your company, it's going to tell you if you are over-levered to growth or over-levered to expenses and investment in the business. And it's going to give you a sense of, do we need to think about reassessing our strategy? If you want to see a good example in real time of the discussion of the SaaS Rule of 40 in an Analyst Day, I recommend you go look at RingCentral's Analyst Day from June of this year. I think the CFO did a great job of intertwining the Rule of 40 with expectations for the company. With that, thank you for watching, and we hope to talk to you soon. Thank you.